Hey, good morning, everybody, and happy Thanksgiving week to all. Anyway, we've got some little cooler weather moving into the Houston area finally. It's a good thing. We still have a bunch of people logging on right now. So let me give it a couple minutes. But anyway, so welcome to today's webinar. It's being hosted by Surge Energy, which is one of my top picks in our small cap growth portfolio because it is heavily weighted to oil. My current valuation of this stock is $12 US, which is double where the stock opened this morning. Surge Energy increased production by 20.5% year over year in 2022. And then thanks in part to a significant asset acquisition from Enerplus that closed on December 19th of 2022, right at the end of the year, Surge is on track for close to 15% year-over-year production growth in 2023, despite having to deal with some field-level production issues in the second and third quarter, which we'll discuss in the presentation. They have a lot of high-quality development drilling locations, which all you EPG members know I call running room, and two of Western Canada's top oil plays. Joining me today is Paul Colborn, President and CEO, and Jared Dukes, the company's CFO. I hope I pronounced Jared's name correctly. Paul is the company's president and CEO. He has over 24 years of experience in the oil and gas industry and has been involved in leadership, executive, or director capacity for over 30 oil and gas and energy service companies. He has successfully grown and subsequently transitioned a number of aggressive Canadian junior oil and gas companies into sustainable, modest growth, dividend-paying companies with excellent results, including StarTech Energy, Crescent Point Energy Trust, StarPoint Energy Trust. At each of these companies, Paul contributed to significant shareholder value creation. Jared is the company's CFO. He is a chartered accountant with more than 12 years of accounting and finance experience in the oil and gas industry. Jared is one of the founding members of Surge, having held several progressively senior positions with the company. Prior to his appointment as the CFO, he held the position of Vice President of Finance. Prior to joining Surge, Jared was a senior associate with Ernst & Young, one of the largest public accounting firms. He continues to be an active member of the Institute of Chartered Accountants of Alberta and the Chartered Professional Accountants of Alberta. Okay, before I turn it over to Paul, I want to point out that Surge's revenues are heavily weighted to oil sales. It pays monthly dividends, and it has a significant amount of high-quality drilling inventory. I love companies with lots of running room. During the webinar, if you have questions, please type them into the chat box and we will answer them after the presentation. With that, I will now turn it over to Paul for an update on Surge Energy. Go ahead, Paul.
Thank you very much. That was a very nice intro. Thanks for having us today. Quite excited about Surge, and but two key points to start. One would be, I don't want to let you guys down. We came down there last year, had a phenomenal meeting with over 30 people in the room. People have backed me in my career, so please look over the last 30 years. I've built with four different teams, great guys, great teammates, four of the best oil companies in Canada: StarTech Energy, Crescent Point Energy. I'm the founder, president, CEO, chairman of the board. StarPoint Energy Trust, and now Surge. I don't want to let people down. And I can talk a lot about that, and Jared can, and even Dan can. The bottom line is quality assets, low risk, low cost, conventional water floods wildly outperform. Surge has two of the best four plays in North America, as written by Raymond James last year, and now this year Peters and Company studies. So we'll show you that. So the second thing is, I want to be the top performer. Last year, Surge was the top performer in the DivCo space in Canada for oil companies. We had 112% TSR. That means share price appreciation plus dividend. 112%. I'm really intense. But so is Mike Rose, and so is Grant Fagerheim and the other top CEOs. I'm sure Scott Sheffield is intense too and stuff. So The bottom line is asset quality drives financial results. No amount of talking can change that. So why was our third quarter a blowout quarter amongst all 12 analysts that cover us for cash flow? Because we have some of the highest net backing assets in the basin. We thought our cash flow would come in around 78, 79 million. It came in at 87 million, 86.9. We paid debt down 25.5 million while paying our dividend and pursuing our capital program. The bottom line, we had over 40 million of free cash flow on the quarter, and we ended up, the stock market loved the quarter, and we put out we had a convertible debenture coming due, 35 million. We refinanced that for the second time after the quarter came out. So wildly successful deal, oversubscribed by 3 times, and we've already bought back, Jared, yesterday.
That's right. Closed the buyback of the June 24 convertible debentures.
Yes, so we bought it back out early, and it was coming due within 6 months. So now that nice piece of paper is sitting there for the next 4 years or 5 years at a fairly attractive interest rate. I mentioned to you the big distinguishing feature is Paul can talk. Oh my God, Paul and Jared can talk in their presentations. What you're buying into Surge, and Dan touched on it, is the best asset quality in the space in Canada. Now I'll show you, though, that's independent. That's an independent study. That's not Paul talking. So, and what does that deliver though? High quality, low risk, conventional water flooded reservoirs that outperform for decades. What does that churn out? If you're disciplined and you don't buy stuff because it's cheap, you always stick to high quality, big oil in place reservoirs, delivers 2 things: net asset value and free cash flow. Those are the 2 ways to value a good oil company. So there's our net asset value. So this is amazing. I've never actually had this in my entire career. So it's hard to grow your PDP NAV. PDP means proved, developed, producing. We have the top engineering firm in Canada. Sproul does evaluates us every year. What that means is don't drill your 1,100 locations, Paul or Jared. You don't get to drill those. Just blow the company down. What's the value in a blowdown scenario? A 12-year drilling inventory does not matter. I don't care about any drilling, no drilling. So it's hard to make your net asset value per share grow on a PDP basis, proved, developed, producing basis, because you don't get to put your drilling upside in there. Ours went up, like it's hard to grow at 10, 20% per share. Ours went up 107% per share. PDP net asset value. This is the best performance in all of Canada for any oil company I'm aware of. Well, that's what that means is we're trading just above our PDP NAV, which from an investor standpoint is really low risk. We think total proved NAV is a great way to value companies. Surge is traded way above our P plus P NAV in a super hot market like we had about a year ago when Russia invaded the Ukraine. So we think $22 is where we'll go to in a good market or a hot market. But suffice it to say, I'll stick with the total proved NAV is $13.72 a share, and we're paying debt down somewhere around 90 to 100 million this year. So we have 100 million shares out. So you could almost add a buck there to the net asset value because the debt's dropping. What's the other thing it delivers? This high quality asset base, free cash flow yield. So in the past, people used to say, hey, and Dan was guilty of that, and so was I, and so was Jared and everybody else in the industry. What's your cash flow multiple? Are you trading at a high one or low one or whatever? Then smart investors started to say, wait a minute, what is left over of your cash flow after your costs of production? And that takes into account your production efficiencies. Are you drilling good plays? Declines? Do you have a low, beautiful water flooded decline like Surge? And netbacks. Do you have a high cash flowing netback? So free cash flow has become the new mantra in our business. And I think it's a good change, and it distinguishes companies. Because if you have a steep decline asset base and you're spending all of your cash flow and then some to replace the declines and try and grow or maintain your production, you're not going to have a free cash flow yield because you're using it all up in your cost of production. So who has one of the best free cash flow yields in all of Canada? Surge Energy, as independently written by numerous companies. The one slide I like here is this slide on the right. National Bank just put out, because we have the best net asset value proposition in our space, and we have one of the best free cash flow yields, National Bank, which is one of the major chartered banks in Canada, be like the Bank of America down there or something, it's huge. They put out this chart and said the bet on an oil price spike, who's the best company in all of Canada to own in the intermediate space? Suncor being obviously first, but they're in a different snack bracket than us. They're a massive company. In the intermediate company space, Surge Energy. I love that.
So for 2023 and as we look forward into 2024, what can you expect from Surge? As Paul said, a very sustainable, low-cost capital budget of only $175 million, maintains an exit rate here of 25,000 barrels a day. That generates $335 million of cash flow for 2023 budget, meaning that there's $160 million left over after that capital program for shareholders and debt repayment. We have a nice 5.5% yield with a 48-cent per share dividend. That takes about $48 million of the free cash. The remaining free cash is going to further rapid debt reduction as we aim to reach some of our debt targets that I'll talk about on this slide.
Hey, Jerry.
Yes.
One of the guys posted, are we talking about Canadian dollars or US dollars? And I know
Great
you're talking.
point. Great point. Every number that we speak about in this presentation from management's perspective is in Canadian dollars.
Okay, thank you.
Yeah. So as we look to continue to rapidly reduce debt and then in turn put more of that free cash in our shareholders' hands, we've put out some phased return of capital framework debt targets. Well into phase one here, where we're paying our base dividend out of about 25% of the free cash, the rest going to debt reduction. But in a matter of a couple quarters here, at current pricing, we expect to be there in Q2. We'll reach our $250 million net debt target. That means that we'll double the distribution bucket for shareholder returns. So that means now 50% of the free cash flow is going out to shareholders. That's that green section of the chart. That's going to take the form of a couple different things. I would anticipate that you'll see things like increases to the base dividends, perhaps a 10% range. And then you'll see significant share buybacks as well out of that free cash flow. And then as we end towards our terminal debt target in phase three of $175 million, I would anticipate that you'll see Surge putting a growth wedge back in. We'll talk about our assets and our ability to step on the pedal and grow. We could very easily add a 3 to 5% growth wedge to production per share on our asset base here and do that out of free cash flow while also increasing base dividends and buying back shares. An important thing to note, a distinguishing feature for Surge up here is our tax position. Many of Surge's peers in the Canadian space are paying significant cash tax. We have $1.4 billion in tax pools. What that means is that for the next 4 years at current pricing, we don't anticipate having to make material cash tax payments to the governments. So we anticipate that we'll be able to return that free cash flow that we just talked about very tax effectively to shareholders.
The macro we're going to talk about at the end, Dan. So all I will say is I believe you have a massive worldwide shortage of oil. It's not being focused on at the present moment with the lowest inventory levels in the last 40 years. And people seem to forget we're at world record demand for oil, growing at the fastest rate of organic growth in any year that I've ever seen. And with the lowest inventory levels, we think that's not caused by the Russian invasion or the war in the Middle East. We think that's caused by 8, soon to be 9 years of chronic underinvestment in our industry. And the beatdown that's occurred since 2020, 2021 continues. This chart is great for investors like on this call. This was put out by the biggest energy mutual fund in Canada. Is 9 Point Partners, over $2 billion fund. They are Surge's biggest shareholder, Eric Nuttall. So he put this slide out. It just says that our industry is punching way above its weight class. We're delivering the lowest valuation multiples for trading. So great for an investor buying stocks at 70, 80, or 90 oil, and the best free cash flow. When you look at the best EBITDA levels, it's a nice combination chart anyways for investors. And remember, oil is a hedge against inflation. We all know this is the highest inflation in 40 years. So oil is a great place to hang out and get cash flows along with it through our dividend. Now I'm going to show you our secret sauce. I bragged a lot. I better be able to back it up for you and your client base. When you buy into Surge, you're buying into the highest quality asset base in the space in Canada. Now our space is the intermediate oil divcos in the country. So get a load of this slide. We created this to show permeability, risk. In fact, you could almost call it a risk chart for an investors on this call. Do you guys want to take a lot of risk on? There's enough other risks in the oil and gas industry. Oil prices, interest rates, commodity prices. It's so fraught with risk. Wars breaking out. OPEC, what are they going to do? In our case, you don't want to add in our business, we're the lowest risk, highest quality asset base in the peer group. What that means is along the bottom, tightness of rock, permeability, 0.1 mil at RC and tight rock on the left of the chart, and 0.1 mil at RC, way better rock on the right. So what this means is deep, expensive, tight reservoirs, basically tombstone under the ground. The oil in place is there, but it's 4, 5, 6% porosity. It's tombstone, Duvernay, the Permian, the Montney. So you're trying to create permeability with massive fracs and turn the rock into rubble to get whatever oil is there. Well, huge costs, huge fracs, huge declines, reservoirs that don't water flood. That's what those are. Well, I don't want those, and Jared doesn't, and our model doesn't, and my guess is the people on this call don't. 0.1 mil at RC and better rock on the right. These reservoirs are shallow, low cost, low decline reservoirs that water flood. Now look at, and that's what Surge owns. Look at above the line there, your PIR, profit to investment ratio. That means how many times you got your money back. You put our wells cost $1.4 million in Saskatchewan, $1.6 million in the Sparky. Some of the Duvernay wells cost $15 million per well. A Montney pad costs $60, $70 million per pad, 6-well pad. Permian similar. Well, obviously the payback on those is going to be a lot longer than a Surge well. So you'll see our chart independently evaluated as two of the best payout ratio pools in all of North America are our two main assets, 80% of Surge. So this chart is one Jared's going to show you. Great. That chart was Paul talking. This is going to try and show you empirically. He's going to focus on the 3 billion barrels along the bottom row, what this means to you as shareholders of Surge.
Yeah, so as Paul alluded to, we control and own under our lands over 3 billion barrels of net original oil in place, so oil under our lands. We've only produced 7.7% of that oil out of the ground to date. The great thing with these conventional assets is they don't stop at 7.7%. They don't stop at getting 11% of that oil out of the ground. Because many of these reservoirs are conducive to water flood and other recovery methods, we can see 20, 25, or 30% of that original oil in place produced out of the ground over the coming 10, 15, 20 years. For example, the $22.37 per share proved plus probable net asset value has only 489 of our over 1,000 drilling locations in it. That only has us taking our recovery factor up to the 11.5% you see on the bottom row. So what does all that mean? Well, let's take 3 billion barrels and only get 1% more out of the ground. Let's go from 7.7 to 8.7% of that oil. Well, that's on simple math. That's another 30 million barrels produced out of the ground. Put a $40 net back on it. That's an incremental undiscounted $1.2 billion of incremental cash flow to Surge shareholders. For context, that's approximately our entire enterprise value today. So that is really the prize. That is why we at Surge focus on these large oil in place per section conventional reservoirs, because increasing your recovery factor by a small percentage leads to huge increases in the amount of oil you get out, which is the real prize to Surge shareholders.
And I would mention for people on this call, you don't get that from Sproul. They're tough on us. They're one of the top engineering firms in the world. So where did that sit? The CTD, cum to date recovery factor last year, where did it sit? 6.5%. So we got 1.2% more oil out of the ground in 1 year. And I tie it back to, why did our PDP NAV go up so much per share? Because our reservoirs start outperforming the Sproul decline, and Sproul gives us free almost recovery factor barrels every year. And when you get on that gravy train, that's what's conducive to the increasing compounding dividend model. And we'll show you that is our model.
As Paul talked about, asset quality is everything for us here at Surge. Pleased to say over 80% of our production is coming from our Sparky and Southeast Saskatchewan assets, which, as we said, are two of the top 4 plays, not only in Canada, but really in North America. And we're directing substantially over 90% of our capital to those plays. And that's because we have an unparalleled depth of inventory here. Over 75% of Surge's over 1,000 drilling locations are in the Sparky and Southeast Saskatchewan. And you can see on the left, Paul will touch on it, why we think these are some of the best plays in North America.
Yeah, so this is a study done this year, earlier in the year by Peters and Company, one of the top energy boutiques in Canada. Last year was done by Raymond James, a big firm of who you guys all know down in the States. In the year before that, National Bank of Canada. So this studies all of the top oil plays in North America, including all your Permian plays down there in Texas, all the Canadian plays. It's got the North Dakota, Bakken, everything in there. The Eagle Ford's in there. So what plays rise to the top? The Clearwater play at Martin Hills is a big one. Surge's Frobisher play in Southeast Saskatchewan's been, frankly, the best play in North America for the last 75 years, one of the best plays. Charlie Lake up here, and then our medium gravity Sparky play. So this is a phenomenal thing. If we even had half our assets in this, I'd be thrilled to be 80% in there and have, as Jared said, 75% of our 1,000 locations are in these 2 top plays. That's what keeps making us have, why did we have a blowout quarter and crush the street on cash flow? All 12 analysts we beat on cash flow because of our asset quality. So this play takes into account all the plays in North America. Now this is it. This is one of the 2 best plays in Canada, and Surge is the big dog in this play. So I won't belabor too much because it's a different state or province for you guys, but Edmonton is the capital of Alberta, sits in the middle. Straight down the line to the south is Highway 2, connecting them to Calgary, kind of central in the province. From Edmonton southeasterly to the Saskatchewan border, it's one of the biggest play trends in Alberta history. 11 billion barrels under the ground, the Sparky horizon. So I thought it was all heavy oil, goo, like I'm talking 10, 12, 14 API. We got in there and said, and it was found in 1922 and drilled vertically with 22,000 vertical wells. 10 years ago, we said, 4 billion barrels of the 11 is not in the goo. It's in light and medium gravity window. So we didn't think that Surge could compete with CNRL, Husky, Cenovus, the big companies, Exxon, that have upgraders and they have refineries and the pipelining and the terminaling and everything. We said we can't compete with them in that. So we'll stay in the light and medium window of the 4 billion barrels, and we can compete with anybody in there. So in 10 years, we've drilled 230 good wells in a row. I don't want to over glorify what Surge did. We spotted the vertical wells, the pay. We developed a proprietary log signature and said, oh my God, that's 7 meters of Sparky pay. You can see on the vertical wells. And all we did is bring horizontal Packers Plus modern technology to those old vertical wells and found big pools. It's so thrilling because in that area of the 4 billion barrels now in the light medium window, we control over 1 billion barrels. 1 billion barrels. We've grown from 0 to 12,000 barrels a day. And we still have 480 locations. We drill about 45 a year in the Sparky. So over a 10-year drilling inventory and beautiful water flood upside. It's literally turned out to be, and now the Manville, excuse me, is one of the hottest plays in all of Canada. So what's exciting is, Jared, you go back one slide there. In that medium and light window, we're the big dog, and we have very little competition. There's one little bit of upside Jared's going to talk about being multilateral technology.
Yeah, so you can see that light and gravity, medium gravity window that's outlined with the blue dashed line. The light gray really represents some of the recent developments, and that's pushing the window into slightly heavier gravity crude, 18 to 20 degree oil. We've been attacking this with multilateral wells. This is how the Clearwater play up here in Canada's come to the forefront. So drilling 8, in our case, 12 leg wells, open hole, unfracked wells, very cost effective. We've drilled 17 of these wells into that window, that halo, wells down on the southeast Saskatchewan border that have done over 200, 250 barrel a day IPs. So a really good success here. And what we think we can do is push our dominance in the Sparky even further into that window. That's going to allow us over time, we believe, to take this from 12,000 barrels a day to 15 to perhaps 20,000 barrels a day over time as we expand our play here. Notably, we've put together well over 20 section land block here at Giltich Hope Valley, drilled 2 exploration and delineation wells. We're out shooting a big 3D seismic program on that land as we speak. So we really think there'll be incremental development here for Surge into the multilateral heavier window of the Sparky. So very exciting development there for us. The next part of the company that we'll talk about is our relatively recent entry into Southeast Saskatchewan. Really, we've gone from 0 to 8,000 barrels a day out here in a matter of just about 2 years. This is really on the back of a lot of technical experience here in Southeast Sask in the team, whether it's Sir Paul's track record at Crescent Point, Derek Christie, our Senior VP of Geosciences track record out here as well. Really identified this as a great complement asset to that Sparky large oil in place medium oil. Light oil down here in Southeast Saskatchewan. Nearly all of our locations down here are unfracked. They're very inexpensive, $1.3 to $1.4 million to drill. They come on production from spud of the well to on production in under 2 weeks and have some of the best netbacks or profit in the field that we know of in Canada or even the US, about $60 to $65 a barrel netbacks, field netbacks at today's pricing. Why are we so excited to be back here? Well, the Frobisher has really been driving our outperformance. This play here has been identified for decades and decades, but Surge has come in here, put together a big land position, and has now put 275 net drilling locations in our inventory. About 210 of those are in the Frobisher. Why do we like the Frobisher? Well, you can see this chart. The Frobisher has delivered IP90, so initial production data for the first 90 days of production on 42 wells of 184 barrels a day. That's the best in the industry. The next company beside us drilled 74 wells, not as good as ours. What does that mean good? Well, these wells are paying out, meaning you're getting your $1.3 million drilling costs back in a matter of weeks, 8 to 10 weeks payback or payout we've seen on these wells. We're seeing 2-time payouts, so all your money back, 100% gain in a matter of 6 to 7 months. So these wells are highly economic, some of the best netbacks in North America, really, and has been a fabulous addition to the Surge model over the last 2 years.
So the last point I'll leave you with, then we'll open it up for questions with Dan, would be analyst coverage. So we had a huge beat on cash flow in Q3. Why? Asset quality. And we also had 40 million free cash flow in the quarter before dividends. So all 12 analysts, 12 of the top analysts in Canada have top pick or a top pick for oil in Canada of the intermediate divcos in the country, with average targets right around that total proved NAV of $13.50 to $14 a share. It just shows, plus you get the dividend while you wait. Plus with the debt pay down that you can see happening now in just a quarter or two, you'll start to see the dividend increase as we hit phase 2 debt targets. So we're thrilled about our positioning. Surge looks good at 65, 70 oil, 75 at 77 or whatever it's at today, $80. We look amazing. And it's nice to get that market recognition. Our goal is be the top performer again this year and next year. And I believe our asset quality will drive that. Dan, over to you then for any questions you might have.
Okay. First, I want to remind everybody I've been following Surge for well over a year now. I do have a high level of confidence in my forecast model for this one. And I have followed a lot of Canadian juniors for a long time. And actually, some of my personal largest gains have been on Canadian juniors. Now, I think there's a disconnect with the valuation of a lot of these stocks, especially the juniors, because some of them are trading for just, 1.5, 2, 3 times operating cash flow, when historically you'd get, 4, 5, 6 times operating cash flow on these stocks. And I think I want to, before we get into the questions about Surge itself, I want to talk to them. We have two experts. Paul and Jared are experts on the oil and gas industry, and especially the Canadian oil and gas industry. And, talk about the macro for a minute, but the price of oil has been extremely volatile this year, trading as low as $67 and as high as 92 just in the last 6 months, maybe even the last 4 months. Before we get into question, and let's look at their slides 10 and 11 on what you sent me. Yeah, I think you're looking at that one right now. Discuss the global oil supply problems and why high quality upstream companies like Surge are still trading at historical lows. So I'll just throw that over to you, Paul, Jared. I mean, what do you think? Why are shareholders not synced up with these companies yet and not willing to pay more than 2 times, 3 times cash flow?
I think good question, actually, but I think some of the trepidation is the 2020 crisis, COVID, Saudi-Russia price war, climate change, negative sentiment that's turned out to be completely wrong, but it certainly scared people. I forget what movie it is, but there's a movie where the guy, Matt McConaughey, asked the jury to close your eyes, sit back, and I'm going to tell you a story. So if everyone on this call did that and closed their eyes, and I said, there's an invasion by Russia of the Ukraine, second biggest oil producer on the planet involved. Oil did jump, in that case, to $128 a barrel. Then, while that war is still going on, there's another war breaks out with the biggest attack on Israeli soil since 1973. And Iran is backing Hamas and Hezbollah, and Yemen is bombing Saudi Arabia, and the US is over there and moved their military fleet in, and Russia and China are puppeteering in behind those regimes. And all, if you step back, it's all for control of oil in the Middle East, where 20 million barrels a day goes out of the Strait of Hormuz. Now I'm asking you, open your eyes, and you would say, I bet oil is $180 a barrel, or 220, or 100.
Yeah, right. Yeah.
And it's 77. It's gone down $10 in the last 2 weeks. So to Dan's point, it has been extremely volatile. And that's why you can rely on 2 things: asset quality, and we're a cash flow model. Do you know, Dan, I sweat so little about my trading multiple when I'm cash flowing these elite reservoirs under water flood, and I'm returning. We got a 5.5%, 6% dividend with a low payout ratio. And you can just see in 1 or 2 quarters, we're going to be paying, we could double the dividend. We're not going to, that's too risky, but we're talking about an 8, 10, 12% bump to the dividend as we hit the next debt target. And I'll just keep spewing out the cash to people tax effectively, as Jared said, so we all can kind of relax and enjoy the cash flows. And that chart that we showed you from Eric Nuttall's firm, 9 Point Partners, we are one of the best valuations. To Dan's point, if you can show that slide, Dan, this one right here.
I know that I agree. That's a key slide. And I listened to a presentation that Eric did where he discussed this slide, and I agree with him 100%. The market is missing this somehow.
And if you're cash flowing and getting a 6% yield and see future dividend increases and a low payout ratio, quality asset base, you just go, hey, keep sending me the cash because I love this trade. So I love our dividend model, Dan, and that would be the answer to my question. What is the market missing? Yeah. I think it's 2020 fear is still in the rearview mirror. The volatility scares people. And that's why I like Surge's positioning now with the dividend.
Yeah. Another thing I'll throw in there is, I follow like close to 40 upstream companies, and over half of them, of the public companies, are buying back their stock. I mean, what does that tell you? Right away, people always, is there insider buying or selling? Is the CEO buying stock or whatever? All these companies are buying back their own stock. I talked to some of them, and they think it's ridiculously low. Like, it's their best investment is their own stock to just buy back and reduce their share count. Because the good thing that happened, I think, because of COVID, when everybody hunkered down and cut back on capex, was they focus a lot of their free cash flow on paying on down debt. So, I mean, you look at the balance sheets today compared to the balance sheets, 2 years ago, and it's unbelievable how much stronger the balance sheets are for these companies. So, I don't know. I just don't see it, and I think I think the volatility of the oil price, as I mentioned, 67 to 92 in the last 4 months, and what the heck's going on, in the Middle East with this war. Keeps people on the sideline for some reason. Instead of thinking it's going to make oil go up, I don't know why would they would think these conflicts are going to make oil go down. And then OECD inventories. Another disconnect we have today is that OECD inventories are way below 30 days of supply, way below. And historically, we should have triple digit oil prices today based on that relationship. So it's really weird. So let's get into some surge questions, and then we'll go from there. Based on my forecast, Surge's operating cash flow should be over $300 million this year, which compares to their 2023 capital expenditure budget of $175 million. So free cash flow should be about 125 million Canadian. We are talking Canadian. That more than covers our current base dividend. So if oil prices stay near current prices, Paul, will Surge be using free cash flow to drill more wells in 2024, or use free cash flow to pay higher dividends? And you may have addressed this question because you're going to start a stock buyback, but go ahead and comment on that.
Yeah, for sure. No, great question. Yeah, we're going to continue to be disciplined here, try and hit these phased return of capital targets that we talked about. So to your good point, Dan, in a matter of a couple quarters, when we hit 250 million in net debt, we'll start buying back stock, increase the base dividend, as Paul alluded to. Really, that growth wedge, drilling more wells, to your question, is something that we're looking at as we get closer towards phase 3, which at budget pricing is towards the end of 24. So somewhere in the second half there, could potentially look at adding that 3 to 5% production per share growth wedge, and start drilling more wells. But right now, we just talked about it, these shares are trading at historic lows across the space. So, buybacks, low risk returns of capital are more where companies like Surge and our peers are looking to put our capital. And as the market starts to pay for growth, we've got the inventory to be able to do that.
Yeah. Do you have a slide that shows your hedge book?
I do. Unfortunately, it's in our corporate presentation, not in here, but I can
Okay.
speak to it for sure. Our thesis on hedging is protect the downside while participating in the upside. And so what that really boils down to is about 30% of our forward 12-month production, so 30% of our oil, we've got that hedged. Of that 30%, half of it, so 15%, is got puts. So basically we have, call it a $65 US WTI floor on our oil. We get all the upside from there. We purchase that insurance. The other half, the other 15%, is wide collars. Call those about 65 by $100 US WTI collars, where we have a $65 floor and we participate all the way up to 100. So that's that idea of providing downside protection in these volatile times while participating in some of the other side of that, the upside.
Yeah. So right now, as oil prices right now, your hedges have no impact at all on your.
Effectively, yeah. No,
Okay.
There's small premiums on some of those puts, but call it less than $1 a barrel.
Yeah. Okay. Talk about the price in Canadian dollars that you're getting for your oil. Let me get my forecast model up here. Okay, I've got that on your oil, on all your oil put together, net of all the differentials and everything, you got $96.54. That maybe I got a little bit of a guess in there, around in Canadian dollars in the third quarter, and it compared to $82 per barrel in the second quarter. So quite a nice jump. So, and then I'm thinking you're going to get over 100 in the fourth quarter because you got more unhedged oil or something. Anyway, comment on that. Like, what's the discount?
Yeah, for sure. So one of the great things about being a Canadian producer is, I guess we benefit from the Canadian dollar being low. When oil's been at these higher prices historically, the FX ratio between Canada and the US has approached par at times. So a dollar US equals a dollar Canadian. Right now, we're seeing about a 73-cent dollar. So to your very good point, Dan, when we think of $80 WTI as a budget number, bring that back to Canadian, you're talking about almost 110 Canadian. So even once you factor in the different differentials for crude quality, pipeline tariffs to move our crude down to your guys' Houston refining complex, we're still seeing, as you alluded to, something like $95 a barrel Canadian realized pricing. I think one of the nice upsides for Canadian producers as we look forward into next year is the Trans Mountain Pipeline expansion. So that's going to be almost another 600,000 barrels of capacity that will, for the first time, allow us to export meaningful quantities of Canadian crude to Asia, potentially. So what that should do in theory is reduce the discount we see on Canadian crudes, because typically till now we've had to really sell our crude only to the US refining complex, a little bit of domestic usage. So opening up different economies, competition for Canadian crude, we really think that differential or discount could narrow. And then to your point, you could see, realized pricing of $100 maybe next year with that pipe on. So a lot of interesting things ahead for Canada, and a real game changer for us on competition for our crude.
Yeah, and I understand that, and that's going to be a plus for all these Canadian companies, I think, when you get that TMX pipeline open. So
for sure, and for the oil producers, and again, as we said, Surge has one of the highest oil weightings in the Canadian peer group, so it should be one of the biggest beneficiaries. Should be us here at Surge.
And I also noticed you got a much better price for your NGLs. Also, you don't produce much NVLs, a small percentage of your production, but a nice bounce back there from the low of the second quarter.
Yeah, for sure.
They got $52 per barrel Canadian on their NGLs up there, so that's helping everybody too. There's a question on here where somebody said it looks like they don't understand. You are drilling horizontal wells in these plays, right? And fracking them and the whole thing, right?
Well, correct in some. So just at a high level in the Sparky, about 80% of our wells are horizontal wells with fracs. So think about drilling a mile-long horizontal well and going in and fracking it 25 to 30 times. There's small fracs, though, about 10-ton fracs. So that's why the well costs are about $1.6 million.
Okay, and you do case these wells, correct?
Yeah, those wells are cased, yeah.
Are you drilling some where you have open hole completions?
That's right. Yeah, correct. So then maybe I'll go to the Sparky slide.
Yeah.
So that's about, call that roughly 80% of the Sparky drilling in terms of the wells that we're drilling here this year and next. Drilling 6 or 7 open hole wells. So uncased, you're going in and drilling open hole wells between 6 and 12 legs. So going in and drilling a leg and then coming in, sidetracking and going beside it. It's really, that's how we're seeing the Clearwater developed. So those are open hole multilateral wells.
Okay.
And those are in the slightly heavier window you can see there. So we've stayed for 10 years in the light and medium window, and now the market, the new technology of the open hole multilats has opened up. So you do give up the water flood upside, but you probably get a more stable, longer life well on primary from the 12 legs. And that's working out really good for us. We have a big discovery called Hope Valley. We have 25 sections of land locked up, 2 wells into it. It looks really juicy. We're stopped to shoot a 3D. So that's for slightly heavier oil than we've stayed traditionally in the past. So it's about 18 API gravity, where our Sparky is about 24 API. This is not the goo. I do want to make that distinction. Up near Lloydminster is the 10, 12 API gravity oil, and it's got sand issues and diluent and blending. Our production, we're coming up to 12,000 barrels a day, no sand issues, no diluent. Some of our production, as Jared said, gets priced up to Edmonton light sour. So we're about 24 API gravity in the 12,000 barrels a day of Sparky.
Yeah, and maybe last on that drilling question. So the wells that we're drilling in the Frobisher down here are they vary, but typically they're a dual leg, half-mile open hole again. So unfracked wells down here in the Frobisher by and large.
And I cannot believe the payouts on these. You're talking like less than 3 or 4 months these wells pay out.
Yeah, that's right. Yeah. Yeah. 8 to 10 weeks on some of our drills here. It's been a fabulous place.
Well, all I could say is if it was me, I'd be drill baby drill on those. I'd use the Trump drilling program. And by the way, we need some of that heavy oil down here if we had a president that doesn't cancel the Keystone Pipeline. Now we're going to be begging Venezuela for their heavy oil because our diesel inventories are extremely dangerously low. And I don't really think that's priced into the market either. So, okay. So, one guy even posted drill baby drill. Paul, you used to be a quarterback. Dan had the football scholarship. Do we need a Hail Mary to win? No, we don't need a Hail Mary to win. We're doing really well. Let's see. I think I had one more question on my thing. Okay, the return. How far are in your return of capital framework would you say you are from phase 3 if we stay at like $75 to $80 oil?
Yeah, so I think at $80 oil on our budget, we would anticipate that we get towards phase 3 in the back half of next year, late Q3 or late Q4.
Okay, and do you think there's any chance you could say increase the dividend payout and go to maybe like a 40% buybacks and 35% dividends or something there, higher dividends?
Yeah, so good point, Dan. Or whoever put that question up, because when we hit the next debt target, which should be Q2, late Q2 sometime next year, so just 2 quarters away, we could increase the dividend under this plan 100%. So we already have a 6% yield. When we hit the phase 3 debt target, we could increase the dividend another 100%. We're not going to do that. We're not going to be that bold. And also it would hurt your sustainability if crude drops. We all know that. One of our peers up here increased his dividend when it's a gas company, when gas ripped last year, 900%. And they were trying to make a statement to the market, our stock's not performing as well as we think it should and whatever. And gas went to $8. Then gas quickly went from $8 to $2, and they now have an 11-12% yield. And the market hates it, and they're having to cut capital to defend a dividend that was probably regretfully oversized. In our case, we're going to just probably increase the dividend, a $48 million dividend, $4.8 million, like 10%, say, on hitting the phase 2 debt target. And we'll do the same. We want to move it up slowly and buy shares back and add a growth wedge as we hit the phase 3 target and keep paying debt down. Like it's a beautiful, there's a lot of buckets of capital allocation we can put in, including the modest growth wedge with that free cash. It's, as you saw on the earlier slide, it's one of the best free cash flow yields in all of Canada. And we want to push it out to people several different ways.
Yeah, several of these companies, especially the big gas producers, I just published an updated profile on Coterra this morning. They were bragging about how great their base plus variable dividend was, and in 2022, they paid out like $2.73, and then this year they've had to cut all the way back to their base dividend, which is only 20 cents a share. So, then people invest for that high yield, and then when it pulls back, they sell. But I don't know. I want a dividend that's sustainable. I want to see it going up, but I want it to be sustainable. And again, you guys pay monthly dividends, which is really great. Where does your debt stand right now? Because this is all based on paying off debt, right?
That's right. Yeah. So as of Q3 there, we announced about a $286 million net debt. So we're in about $35 million of getting to phase 2 as per Q3 release. Expect to be there, as Paul said, in Q2.
Okay, good. By the way, okay, the Enerplus asset acquisition was in December of last year. Can you show us where those assets are and how are they doing?
Those are beautiful, big. I'm glad you asked that. That is completely in our wheelhouse. So I'm just letting you know how hard it is to get an asset base like we have. Everyone, you on the listeners on this
I
call may
agree.
go, well, yeah, Paul's done this, he can do this easily. I chased those assets for 7 years. 7 years. And I was all over the president of Enerplus, is a good buddy of mine, Ian Dundas. They're a brilliant company. He's like, no, why would I sell my best water floods in all of Canada? Then out of the blue, they decided they wanted to exit Canada. They're in the North Dakota Bakken and the Marcellus. So they decided to sell out of all of Canada, 9,000 barrels a day. There was 5,000 we didn't like. Another company bought that, and we got to go in with a rifle and pick 2,000 barrel to 2,000 barrel a day beautiful water floods in the Sparky. So Jared's going to point to you. It's right there, that big glob of land, and that happily coincides with, if you can believe it, our Hope Valley Sparky play. So that's a beautiful Lloyd water flood, around 2,000, just under 2,000 barrels a day. Then there's one more asset down below here. We had a hole in our donut, and we saw 40 tier 1 Sparky lokes that Enerplus was not drilling. We have a huge discovery under the city or town of Provost and just to the west. And this Cadogan property sat there, and we bid on it 7 years. Think of how hard that is. Then we get it. It was only about 450, 500 barrels a day. We've already drilled, we see 40 locations. We've already turned it into almost 1,500 barrels a day, 1,200 say barrels a day, drilling the first 8 wells. We see 32 more to drill. So a hole in the donut. The other one is, look at these water floods here, the Radcliffe water floods. So the 4,000 barrels a day we bought from Enerplus had a 7, 8, 9% annual decline. It's amazing. And so these assets are producing almost exactly what we paid for 10 months ago. And that's actually why Sproul gives you that recovery factor every year. Sproul probably put a 15% decline in those because they view themselves as the independent keeper of the public gate. And then at the end of the year, you show them, yeah, but these Radcliffe water floods, they're the same production they were a year ago under water flood. Then they go, oh yeah, okay. And they go click and give you all the reserves back that you produced the prior year, but they don't change the slope of the decline curve. It's a little game because they don't want to get caught on the wrong end of it 20, 30, 40 years from now. So all I'm saying is that's one of the reasons you have those big oil in place water floods, that you keep getting those recovery factor barrels, and they really help your PDP net asset value.
Yeah.
Good question.
Yeah, well, and for everybody that's on this call, if you're not got decades experience in the industry like we have, these third-party engineering firms that do this, that get paid to do your reserve reports that are in your annual reports, they are extremely conservative estimates because they can get in trouble. It's just like an auditor, like the public accounting auditing firm that does it. If they make mistakes and they overstate the value of the company or don't miss something on the unrecorded debts or something, they get in big trouble. It's the same way with these guys. So, but if your wells hold up and they produce above their type curves, which is what we're seeing here, we're seeing it in play, we're seeing it in Hemisphere, and then you're going to get nice reserve edge year after year after year just on those wells. So, and then if you're adding more and more wells, proving up more and more your acreage, your PDP is going to go up, your P1 is going to go up. And go back to that slide where it shows what your net asset value is, where you X7. There's absolutely no reason that any of these companies should be trading below their total proved, the 1P. So they should all be trading above that because you're based on extremely conservative reserves. So, and the reserves are going to go up year after year. And so the more wells, and how many wells you guys are on? Like 45 a year or something?
We're drilling about 65 a year this year and about 70 next year. And about 45 of those are Sparky and about 30 are Southeast Sask.
So all those wells are going to increase, PDP and P1. In addition to those wells, they're going to get more, offset locations put in their P1. So no reason that this should happen. And the only way would be, but we think the oil price they used was too high or something like that. Well, fine, but take some kind of discount, but not like trading at half Trading at half that value. That's crazy.
Yeah,
Well,
like
anyway,
I'll have this meeting, Dan, with you next year and tell you how great we are when we're trading at total proved.
yeah.
But right now we're trading just over PDP. So traditionally, so my point, what happened to Surge when Russia invaded Ukraine? Surge went from 368 a share to 1350 a share in 5 months.
Yeah.
So I don't know when it is, but the political risk premium has come out of the barrel of crude. We have a second war going on. I'm just going to say it again, in the Middle East, the
I
biggest
know.
purchasing area in the world,
Yeah.
and oil's dropped $10. So getting paid while you wait, a nice juicy dividend, low payout ratio, and then as Dan said, the visibility on the total proved NAV. And really, Dan, we're paying debt down 100 million, call it 90 million this year. We've already paid it down 66 million to date. So, and we have 100 million shares out, so you could almost add $1 to the total proved NAV at 1472 or whatever, and the less risk of having a company with way less debt. So
the only thing that if I have to make up something to justify these low valuations, it's fear of recession.
yeah.
I mean, nothing's pointing. I mean, the copper market is not pointing to a recession. I just got a note from Adam Rosenzweig this morning that nothing's really in the real world. Nothing's really pointing to recession, except it's like the most advertised recession in the world. And I really think they keep throwing it out there, just like they keep throwing, oh, China's demand is going to go down. China's demand is going to go down. Well, maybe the Chinese economy isn't as growing at 8% or something like it was before, but it's still growing. and their people want higher standards of living, and that means more energy demand. So I just don't get it, but it's this lack of confidence in oil prices or something, and you got to make stuff up to justify it. It's really weird. Let's see. Are you seeing? What do you think the acquisition market is? There more bolt-on potentials in those areas, or maybe not even in your other areas?
Yeah, we are seeing a lot of little private codes that were private equity backed that are 1,000, 2,000 barrels a day in both Southeast Sask and Sparky. A couple of those we've discarded as not having the asset quality we want, the oil in place or place per section targets we have. We're trying to target 5 million barrels in place or more per section in the Sparky, and 3.5 to 4 in Southeast Sask or more. So, but we are seeing some that we might bid on. So there are several of those in both the two operating areas. We now have over 80% of our company in those two areas. So we're getting pretty choosy to, to look at the little companies and see if they have the good assets, we want to buy them. If they don't, we discard them quickly, but nothing big, Dan, just small core area top-ups.
Yeah. And you got enough inventory. I mean, you got 1,000 locations, so you don't need any more acquisitions.
Exactly.
Hey, comment on what's the current gas price in NGL? What's the market up there look like up there?
Yeah, great question. So NGLs are really an absolute rounding error for Surge. So what I'd probably touch on though is the gas pricing. So when we look at next year, just like oil, we get your NYMEX gas price minus a transport differential that moves around. But right now in Canadian dollar terms, think about kind of $3 per gigajoule gas up here for what we call AECO is the gas pricing up here. So again, pretty healthy. It follows that same idea of taking the US dollar benefit and then paying a bit of a transport toll.
What's in Canadian storage? What's your storage look like up there?
That's a good question. I'd have to pull that number. It's about 95% of our cash flow comes from oil. So Surge is almost singularly focused on the oil market up here. But the gas market here has been pretty standard, pretty average when I've looked at it here recently.
It's firmed up a little bit. I noticed like some of the other ones. So are any of your I know you got a lot of water flood potential, but is there polymer flood potential too?
We have one polymer flood pool, the one we got from Interplus, where they tried it. The water flood was working like a dream, so we just stuck with the water flood. It is an option we have, but a lot of our pools, other than Wainwright, a lot of our pools are newly flooded and working well. Usually you look at polymer flood after you've exhausted water floods. So, and you get to 20-25% recovery factors, then you look at the reservoirs and decide whether they can flood. So our pool at Provost, our pool at Cadogan, our pool at Big Discovery at I Hill, we had a pool at Sounding MM pool. All of those are newer floods other than Wainwright, which is an old flood that's at a 37% recovery factor under water flood. So yeah, we don't have any polymers, but at the end of the day, we have kind of newer Sparky floods. At the end of the day, there may be several floods we look at, but we haven't had to so far.
Okay, good. Have you considered selling your non-core assets to pay down debt, increase your drilling rate or whatever?
So we have done that. We used to have quite a bit of non-core, and now we're over 80% exit this year in the two main core areas. And the other properties are just kind of two main properties that the Shaughnevin's kind of 1,000 barrels a day. That is one we looked to sell earlier, and then diffs blew out. So the vendor or the purchaser couldn't kind of fund. Now diffs are coming back in quickly. So that one we might sell and put the money back on the debt and into core drilling.
Yeah.
But,
I mean, you could replace that amount of, just drill 5 more wells or something, right?
You got it. And that is the plan. But we really, other than Shaunavon, our other stuff is beautiful, long life, light oil cash flowing properties. So we use that cash flow to pay the dividend and fund the drilling. Would we sell other stuff? Sure, little stuff, but we've really cleaned up things over the last 3-4 years since COVID.
Yeah, everything's for sale at a price, right?
You got it.
Hey, so where do you stand? Are you getting calls, people wanting to buy you? And do you have any protection from a hostile takeover?
Yeah, so securities laws have changed a lot. I used to be a securities lawyer 100 years ago.
Yeah.
And if Dan, you made a hostile bid on me, I had 21 days to find a white knight. That's it.
Wow.
Now under the rules, Husky made a hostile bid a few years ago to buy Meg Energy, which is a successful SAGD company up here. And Husky's obviously the big heavy oil company. Meg had 100 days under new law now in Canada. It went 21 days, 35 days. I think it was 75 days. Now it's 100 days to find a white knight. And it gave Husky an option to just kind of stick with it. And then at the end, crude crashed and during COVID, and they walked away from the bid. So we are, I think some of our assets are coveted, especially the Sparky by bigger companies. Cenovus, which is Husky now, Cenovus, they have the upgrader, the refinery. You saw the going public transaction with Strathcona is in that heavy oil corridor. CNRL, Tyne Energy bought some assets in the Sparky north of us. So I do think, breakup of the company is, I've done it almost as much as anybody if it makes sense to break up, but we traded an okay multiple. I don't really worry about my stock price, Dan, too much. And I did more when I wasn't cash flowing. I got all concerned, and now it's kind of comforting that we know that demand is going up to the right, contrary to what everybody says. Yeah. And supply is, the Permian is flattening out. And it looks to me like when you put China, India, Asia, and Africa, 6 billion people out of 8 billion in the world today need every barrel. The Gary Rosenweg guys that you mentioned, they're talking about India now as being China 20 years ago. And guess who is the fastest growing oil consumer on the planet? Is not China anymore. China's surpassed the US as the biggest importer, but it's India. India is doing what China did. So you should look at the sheer numbers in the macro. It's 6 billion people out of 8 need every barrel. I laugh when people talk about oil demand dropping. It's up to the right. It's hilarious.
That's one. I went to an Exxon presentation about 6 or 7 years ago. And the one concept that everybody needs to understand, actual demand for oil-based products is much higher than I think. It's just being rationed by price. The price will keep going up because it has to, demand has to be what supply is. So you keep having to raise the price because demand always exceeds supply because there's 7 of the 8 billion people on this planet that want a higher standard of living. And the only way to get that is oil-based energy products, right?
Yep.
The only way to get it. Either you can burn wood, you can burn cow dung or something, burn more coal. But if you want a high quality living without massive pollution, it's oil-based products, oil and
Dan,
gas-based products.
just to prove your point, we're at world record coal demand, which is
I know.
It's so wrong what people are saying about carbon.
I know. And you know what? I put a slide. I don't know if you saw my weekend podcast. Somebody sent me an article that had a really interesting slide. Since the Paris Climate Accord was signed, China and India have built and put into service more coal-fired power plants than all of US, Canada, and Europe have shut down. So
Right.
Here's the energy transition. We're transitioning carbon emissions from the west to the east. That's the transition. They're just building more and more power because they have to, because they have populations that are massive, that are demanding better energy. You know, they want electricity 24/7 like we have. The only way you get that is with coal-fired power plants.
Yep.
So, or nuclear, and you know, they take even longer. Okay, let me just get a few more quick. Okay, I think we get that one. Okay, we talked about your hedge strategy. Why did your latest debt financing have to pay such a high interest rate when it was so oversubscribed? Well, it's just because we're at higher interest rates, right?
Yeah, exactly. I mean, I think, yeah, that wouldn't call it. It's one of our lowest cost pieces of debt. The reserve-based lending facilities up here in Canada are touching 9% on their rates. So actually, I think we believe it's the opposite. It's one of the lowest costs of capital, especially when you factor in the 5-year term and the lack of covenants. It's very covenant light. So we believe it's very flexible and capital efficient.
And the conversion price, Dan, is sitting at about 60% higher than we're trading at.
Yeah. So if
a few million shares get exercised at $13.25 a share, hallelujah. Like it's just had a call with an institutional investor in Canada who said, I can't believe you got such a good interest rate on your convertible debenture of 8.5. Most guys would be 9.5%, 10%.
Yeah, especially when the conversion price is much higher than where you are.
Exactly.
Yeah, you wouldn't expect it. Here's something I want to remind all the listeners. Okay, if you're going to include the additional stock from a converted debt in your calculation, so you need to use, fully diluted share count, then you have to adjust the balance sheet for the debt going away. Then that debt will become equity. That will improve your balance sheet ratios, which will demand higher equity prices for the stock. So you can't just do one side of that. You can't just say, oh, if everybody converts their debt, we got to add another 20 million shares or something. Well, yeah, but you got to take that debt off the books too, and the interest expense off of your forecast models.
Totally.
Yeah, totally. And that's an error that even some analysts make. They only take one side off. So yeah. Okay. How does Surge decide how to allocate free cash flow between debt repayments, base dividend, and share buyback? I think you're just going to say no company has gone bankrupt due to too little debt. So why wouldn't we just focus on debt reduction? I think you are kind of focused on debt reduction.
Yeah, even as we hit phase 2 here, half of our free cash is still going to debt reduction, right? And even in phase 3, that blue box, there's still 25%. So,
and the debt you're paying off is your credit line, right?
Yeah, we're paying off credit line, then quickly we will be paying off some pieces of the term debt, the slightly higher cost components. So we'll be focused on the highest cost pieces of debt, and will continue to pay down debt throughout all these phases. So agree with that comment.
Yeah. Do you see any justification? They said that your stock price came down from 702, then US, I think, on November 3rd to $6 trading today. It's my guess. It's just the oil price, right?
Oil prices dropped from 90 to 77. So
yeah, it's affecting all of them that way. So, and this way I look at it, you have to, as an investor in this sector, you have to have a long-term opinion of where oil and gas prices are going. you'll go crazy. You will go crazy trying to buy and sell stocks every day. If you're just going, oh, is the oil price down? I'm going to sell. I'm back. You get caught on the wrong end of that. So decide for yourself, do some research, study it, and decide, where do you think oil prices are going to be next year? Where do you think gas prices are going to be next year? And that's how you should be investing. Just my opinion. Again, what's your strategy now? Cash flow to investors to acquire or to grow footprint. I think you got to, okay. And what's your break-even price at Sparky?
So our break-even price for the company would be about probably $35 WTI to where, but on a cash flow basis, what would we be break even for drilling and dividend is probably 66, 67 WTI. And it would have to stay there for several months under our credit agreements. So yeah, we've got a lot of cushion there.
So your debt covenants, do they require hedging? A certain percentage hedged?
Yeah, they require that 30%.
Okay, so and you got
to do it in the ways we talked about. Yep, so we're meeting all those, of course.
Yeah, and I personally love your hedge strategy with the buy puts and use collars with high ceilings, and those ceilings. That is the one thing we said in U.S. dollars. So when you say they got $100 ceilings or something, that's U.S. dollars.
Those are all U.S. WTI numbers that I referenced.
Yeah, they're WTI collars. So let's see, we can. We've had a lot of M&A activity down here, as you guys may have noticed, but there hasn't been much M&A activity in Canada. Would you guys ever go after another company? Would you go after an in-play or a hemisphere or something to acquire?
Oh yeah, no. We there's a public company called Gear for sale.
Yeah.
It's about 5,700 barrels a day. Not that big, but we decided to pass on it for technical reasons. Nice company though, low debt, but not a great fit for asset quality for us. I think they've done a good job and they want to monetize it. So it's a public sale process. We do have some private companies, as I mentioned, that in those two core areas, but they're smaller, Dan. They're kind of top ups. And we look at a lot of stuff, but I would say only 10-15% of what we look at has the asset quality. Then when you hone in on it, there's probably only one or two that you think you can actually get and buy.
Right. All these companies, I would say, I did M&A work for Hess for 3 years. And, several of these, half of our Sweet 16 are screaming takeover targets, if you ask me, at the current price. The problem is, doing M&A, it's expensive, a lot of legal fees. You got to have, a lot of other stuff. You got to take on some debt, issue more stock or whatever. But anyway, and some like Hemisphere maybe is just too small. I mean, it's just too small to do it unless they want to be, unless they come to you, unless you can get a friendly takeover thing. But
yeah, like
anyway.
Hemisphere, it's done a good job, and
yeah,
for Surge, it actually trades at a higher multiple than we do, so it's hard for us to buy a company like that. So
yeah.
Jared and I have another corporate meeting here.
Okay.
With the shareholder. Do you have any other last questions, Dan, that you want to get answered?
No, I think that about does it. Good job, guys. I think the company looks great, and I'm glad we have it in our small cap growth portfolio.
And for those on the call, Dan, for those on the call and you, that was a blowout quarter on cash flow. Production's holding in fantastic. We don't want to let you down. We want to be the top performer again this year and next year, like we were last year. And you can rely, Dan, on that asset quality. You know that as an analyst, but for people on the call, I loved it when we came down and saw you guys in Texas. It was a great trip, and I could not believe the knowledge and the smartness of the people in the room. They understand the industry. So we really appreciate the call, and we will get down there again. Our plan is to be there at least once a year and maybe do a call like this every quarter with Dan. And thank you, Dan.
Oh, great. Thank you. Thank you for supporting our webinar program. It's really helpful. And we're really trying to ramp up our luncheon program again. We had 40 people at the last one. So maybe after the first of the year, you get your, plan for 2024 set, and that'd be a good time to come down.
Sounds great.
All right, buddy. Hey, thanks a lot. We'll end it here. We did record this. The link to the recording will go out this afternoon to all of our members, and then it will become, in about 2 or 3 weeks, a public YouTube video, and several of our webinars have gotten over 1,000 views. So it'll get more exposure for the company. Thank you,
Sounds
guys.
great. Thank
Yeah,
you.
thank you very much.
All right.